I think we just looked back, historically went back to the 1980s, late 1980s, and realized that the shortest period that the Fed has been in pause has been 4 months, with the longest being 14 months, mostly a policy mistake back before the GFC. So in our view, first of all, there is no reason for the Fed to cut rates, certainly with the economy where it is and inflation still maintaining the levels. But interestingly, the day the FOMC raised rates by 25 basis points, it wasn't just the Fed fund futures, but also the 2-year spread versus the Fed funds rate was at a record level, suggesting that the Fed should have been cutting rates rather than raising rates.
That is extraordinary.
Thanos, if we do see a move towards market expectations, a pivot from the Fed later this year, what signals does that give to the broader market that's been looking for the clues that the Fed is cutting?
We started the year on a more constructive note. From a geopolitical point of view, we expected there's too much negativity in there. Our view on inflation since a year ago has been more constructive. We see a downward trend continuing, which we still believe. However, not to the 0 to 2% level, but more towards a sort of 3% level. And also, we expected the Fed to have reached its overall final level. In our view, however, the market has been very defensive. Everyone we speak to, everything we see is the fear that people are underinvested. And the pain trade in that sense would be for the markets to continue moving higher. So any sign of a pivot from the Fed, in our view, would boost that sentiment towards a higher market.
Bad news can be good news in the sense, and we've had some interesting snippets of information in other global economies. And Germany yesterday in recession, a sign of weakness if you take that headline. Today, Tokyo inflation coming back towards what the Bank of Japan wants. It's 3.3, the target's 2%. These are much more normal numbers than what we're used to. If we look for a canary in the coal mine, we look for sort of evidence that there's a weakening taking place. Do you think we're getting more and more evidence that that's happening?
The one area which and we've been positive, but the one area which we are sort of slightly more worried recently is China. It's not so much Japan, it's not so much Germany and Europe, nor the US, but it is China, where we have been on the front foot, we have been sort of positive, but the latest signs of economic analysis, even though the markets were wrong-footed, being very negative towards the end of last year and very positive in the early part of this year, still the absolute levels have been a little bit weaker than we would have liked. So this is something we're very much keeping into the microscope and saying, what is the impact in China? Services are doing well. What about manufacturing? What about the exports? So if you were to pinpoint one area of some potential weakness, is China, not so much Japan or Europe or the US.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.